During my years as an institutional trader, I saw the same mistake play out over and over. Most investors think buying an IPO means getting in early, getting in before everyone else. But when you actually understand how the process works, and I mean really understand it, you realize something that changes everything. You are not first, you are last. The venture funds got in years ago, the private equity funds got in at a fraction of today's price, the institutional investors got their allocations during the book building process, and by the time the stock hits your brokerage app on day one, you are buying what they are selling. In the institutional world, they have a specific name for people buying on day one. They call them exit liquidity. SpaceX just filed its S-1 prospectus with the SEC. For those unfamiliar, an S-1 is the initial registration form a company must file before it can be publicly traded, and it lays out the entire financial history and every risk they face. SpaceX is targeting a valuation of up to $1.8 trillion and seeking to raise additional $75 billion, which would make it one of the largest IPOs in history. I read the entire filing, not just the marketing headlines. So if you look at the first few pages of this S1, it looks more like a glossy magazine than a normal filing. It is full of high-res photos of rockets launching, astronauts in orbit, and Mars renderings. Everything screams space. But here is what's interesting. You know what you don't see in those photos? A single image of the X platform, not one screenshot of Grok, no pictures of the colossal data centers of the AI infrastructure that actually dominates this IPO's valuation story. The very business that account for 93% of total addressable market in this prospectus are nowhere to be found in the opening pages. It is so heavily marketing driven that you'd be forgiven for thinking it was designed to make you forget what you're actually buying. And by the end of this video, you will know how to look past those photos and read any IPO prospectus yourself. The three specific sections most investors skip that tell you everything about the real risks and the real opportunity. Let's start with how IPOs actually work, because this is the part most people never learn. When a company decides to go public, it hires investment banks called underwriters to manage the entire process. In SpaceX case, Goldman Sachs is the lead, with Morgan Stanley, Bank of America, Citigroup, and JP Morgan running the book. 23 firms in total. Now, here is what most people don't understand. In a firm commitment offering, which is generally considered the standard arrangement for an IPO of this size, the underwriters actually buy the shares from the company first. They take on the inventory and then they sell those shares to their clients. Pension funds, mutual funds, hedge funds, and high net worth individuals. Think of it like a real estate developer who builds 100 apartments. They don't sell them one by one to random buyers. They sell the entire block to a distributor, and that distributor has a massive inventory to move. So they place those units on the market, and because the supply is so large, it acts like a wall. The price doesn't move up easily until every unit is absorbed. Keep that mechanism in mind, the way underwriters manage this supply. It becomes critical when we look at the SpaceX numbers. And there is one more tool the underwriters have. It is called the Greenshoe option, which is the only SEC-sanctioned method for legally stabilizing a stock price after an IPO. It allows them to sell up to 15% more shares than originally offered, so if the price rises, they buy from the company at an IPO price. If it falls, they buy from the open market, supporting the price on the way down. This is a clever system if you think about it, just not necessary for the retail investor. Now let's look at what the actual prospectus says. And here is where it gets genuinely interesting, because these numbers tell a very different story from the headlines. SpaceX reported $18.67 billion in total revenue for 2025. That's a 33% increase over 2024. That's impressive. But here is the part most analysts misses. That revenue number now includes xAI, the artificial intelligence company that merged with SpaceX in February 2026 in an all-stock transaction, but it doesn't stop there. If you go to the basis of presentation section on page 2 of the prospectus, you will find a quiet but extraordinary disclosure. The financial statements have been, and I'm quoting here, retrospectively recast to include the operations of X Holdings Corp and xAI for all periods presented. Let me explain what that means in plain English. xAI acquired X Holdings, formerly Twitter, in March 2025. Then SpaceX acquired xAI in February 2026. And now by recasting these financials retrospectively, they've made it look as if these three businesses, a rocket and satellite company, a highly capital-intensive AI startup, and a distressed social media platform, were always one entity. They justify this by noting these are transactions between entities under common control. This is not the same SpaceX you've been following. It is a combined entity, and this distinction is critical because you can no longer see what SpaceX looked like as a business. The retrospective recast erased that history from the financial statements. When you break it down by segment, the picture becomes clearer, but only partially. Starlink, the satellite internet business, generated $11.4 billion in revenue and $4.4 billion in operating profit. This is a genuinely profitable, fast-growing business with over 10 million subscribers. The launch segment Falcon 9 Dragon Starship brought in another 4.1 billion, and the xAI segment AI Grok and the X platform contributed to $3.2 billion. Now here is what caught my attention, and if you go to the Our Market Opportunities section of the prospectus, SpaceX claims a total addressable market of $28.5 trillion. They call it, and I'm quoting directly, the largest actionable TAM in human history. But look at how that number breaks down. AI accounts for $26.5 trillion of it. Connectivity, which is Starlink's the actual profit engine, accounts for just $1.6 trillion. And space, the thing people actually associate with SpaceX, is $370 billion. Let me say that again. 93% of the total addressable market that justifies this 2 trillion valuation comes from AI, not rockets, not satellites, AI. This is where the story gets genuinely interesting, because what SpaceX is doing, whether intentionally or not, is riding the wave of the AI boom in equity valuations. Think about it this way: SpaceX as a standalone aerospace company was profitable. In 2024, before the xAI merger, SpaceX reported a net profit of $791 million. A capital-intensive hardware-heavy rocket company that actually makes money, well, that's impressive and it's rare. But capital-intensive aerospace companies trade at very specific multiples. Traditional aerospace companies like ULA typically trades at 1 to 2 times profit to sales. Even RocketWap, which is the market favorite right now, trades at roughly 60 to 80 times. But SpaceX at its IPO target is seeking somewhere between 90 to 100 times forward revenue. That is not an aerospace multiple, that is an AI multiple. And the only way you get to an AI multiple is by bundling an AI company into your IPO. By merging xAI into SpaceX before the IPO, the combined entity can present itself not as a rocket company going public, but as an AI and space infrastructure platform. The AI narrative lifts the valuation of everything, the rockets, the satellites, the whole package. It is a clever structural move, and the document itself tells you this if you know where to look. But the xAI segment, the AI infrastructure business, consumed 12.7 billion in capital expenditures in 2025 alone. And in the first quarter of 2026, AI infrastructure absorbed $7.72 billion of the 10 billion total capex. That's 76%. The AI business that justifies 93% of the TAM is also responsible for the overwhelming majority of the cash burn. And this is where the story changes. Let me show you the number that matters most. Free cash flow, which is operating cash flow minus capital expenditures, and is essentially the cash the business actually generates after paying for everything it needs, was negative $13 billion for 2025. And in Q1 2026 alone, it was negative $9 billion. Let me put that in perspective. Cash on hand dropped from 24.7 billion to 15.9 billion in a single quarter. That is a burn rate that sounds made up, but it isn't. And remember, before the xAI merger, SpaceX was profitable. 791 million net income in 2024. After the merger, a 4.94 billion net loss in 2025. The xAI integration didn't just change the narrative, it fundamentally altered the financial profile of the company. And here is the part that should concern any serious investor. Because the financials have been retrospectively recast, you cannot evaluate the core economic engine of the space business in isolation. The spectacular top-line growth of Starlink is now being used, whether intentionally or not, to mask the advertising revenue bleed at X and the multi-billion dollar compute costs for xAI. The profitable rocket company is being forced to carry the financial burden of the other ventures. In the investment world, we have a term for this: diversification. So we are getting to the part of the prospectus that genuinely surprised me. Now, this strategy, bundling multiple businesses together to capture higher valuation, this is not new. And if you know your financial history, the comparison that immediately comes to mind is AOL and Time Warner. In January 2000, AOL, an internet service provider riding the dot-com wave, merged with Time Warner, one of the largest traditional media companies in the world. The deal was valued at roughly $165 billion. AOL had lower revenue, fewer employees, and fewer tangible assets than the Time Warner. But because it carried an internet valuation, the AI equivalent of its era, AOL's shareholders received 55% of the combined company. The strategy was identical in principle to what we are seeing with SpaceX and XAI. Take a high multiple new economy business and merge it with a lower multiple asset heavy business. The internet narrative lifted Time Warner's valuation. The AI narrative is lifting SpaceX. We all know how the AOL-Time Warner story ended. When the bubble burst, the company took a 99 billion goodwill write-down. At the time, the largest corporate write-down in history. By 2003, they dropped AOL from the name entirely. By 2009, they finally separated the two businesses. Now, I'm not saying SpaceX is AOL. The businesses are fundamentally different, and XAI has a real revenue and real infrastructure. But the structural mechanism, using a high multiple narrative to inflate the valuation of the combined package, is the same playbook, and it's worth being clear about that because the prospectus itself tells you so in the risk factors, where it acknowledges that, and I'm paraphrasing, the estimates of future market opportunity and forecasts of market growth included in this prospectus may prove to be inaccurate. And there is another important detail. The XAI acquisition was a common control merger. Elon Musk sat on both sides of that transaction as the controlling shareholder of both SpaceX and XAI. The valuation assigned to the merging entity was essentially self-assessed, not determined by an arm's length negotiation between two independent parties. That is not to put too fine a point on it, a difficult arrangement to evaluate independently. And this brings us to the related party transactions section of the prospectus. The S-1 reveals that SpaceX has made hundreds of millions in purchases from Tesla, Megapack, energy storage systems, electric vehicles. Tesla previously invested $2 billion in XAI, which converted into SpaceX equity during the merger. The companies share engineering talent and co-develop AI chips. SpaceX also used a $20 billion bridge loan to pay off XAI existing debt, consolidating it into the SpaceX balance sheet. Now, to be fair, related party transactions are not inherently problematic. Many large conglomerates have them, but the question any professional analyst asks is this: were these transactions conducted at arm's length? Meaning, would an independent third party have agreed to the same terms? The prospectus also reveals a dual class share structure. Class B shares held by Elon Musk and select insiders carry 10 votes per share. Musk owns approximately 42% of the equity but controls roughly 85% of the voting power. The company operates as a controlled company, which is a diplomatic way of saying it is exempt from certain Nasdaq governance requirements. And let me be specific about what those exemptions mean. No guarantee of a majority independent board. No independent compensation committee, meaning the people deciding how much the CEO gets paid are not required to be independent. And no independent nominating committee, meaning there is no independent check on who gets appointed to the board in the first place. If you buy Class A shares in this IPO, you are not a business partner. You are providing the capital to finance the driver's other ventures, with zero say in the destination. This is the kind of structural detail that historically creates the widest divergence between prepared and unprepared portfolios. And there is one more detail hiding in plain sight. On the cover page, SpaceX is incorporated in Texas. Now, Texas is a wonderful place to do business, but if you know corporate law, this is a very deliberate choice. Historically, most major companies incorporate in Delaware, and for good reason. Delaware's Chancery Court has strict, well-established case law that protects minority public shareholders from self-dealing by controlling owners. Given the recent history of Musk's compensation packages being heavily scrutinized and even struck down by Delaware judges, this move to Texas looks like a preemptive strike. It is a calculated legal maneuver designed to ensure that the courts are less likely to interfere when the controlling shareholder moves money between the various entities. It's worth keeping that in mind. And finally, and this applies to the valuation question more broadly, look at the use of proceeds and capitalization tables in this prospectus. The printing and the share counts are currently left blank. Now, that's normal for a preliminary S-1, but when you combine that ambiguity with the fact that this company is simultaneously a rocket manufacturer, an AI computing cluster, and a social media platform, how exactly do you price it? Is it a space company? Is it an AI infrastructure play? Is it a media company? The answer is it's all three, and that makes independent valuation nearly impossible for any single investor. Now, the lockup structure is also unusual. Instead of the standard 180-day cliff where all insiders can sell at once, SpaceX is using a staggered system. 20% unlocks after Q2 earnings, an additional 10% if the stock trades 30% above the IPO price, then 7% tranches every few weeks. Musk himself is locked for 366 days, which is worth noting. The weight of evidence suggests this is designed to smooth out selling pressure. The practical effect is that supply hits the market in waves rather than all at once. So here is the mistake I see constantly, and it's completely natural. Investors look at the first day performance of IPOs and assume that's the investment return. In 2025, the average IPO saw 35% first day pop. That's the number that makes headlines. That's the number that creates the fear of missing out. But academic research, spanning decades, including data from the University of Florida, shows that IPOs underperform companies of similar size by an average of 3.6% per year over the next 5 years. When you adjust for size and valuation, it's still 2.1% per year. The first day pop and the long-term return are two completely different things. It's economic equivalent of judging a restaurant by the grand opening party instead of the food. And the history is consistent. In the 2000s, roughly two-thirds of all IPOs were trading below their offering price by year-end. Pets.com filed for bankruptcy 9 months after going public. In 2008, nearly half of all new issues failed on the first day. Now SpaceX is not Pets.com, so this is a company with $18.7 billion in revenue and a genuinely dominant position in launch economics and satellite connectivity. The comparison would be intellectually dishonest, but the underlying mechanism, the symmetry between how IPOs are priced and who benefits most from that pricing, this is timeless. And this is where everything we've been discussing so far finally comes together. So how do you avoid getting caught in the first day hype? You don't need a 3-step checklist, you just need to know how to read the story the company is trying not to tell you. It starts with ignoring the top line revenue. Everyone looks at revenue because that's the number the marketing team wants you to see. But if you want to know if a business is actually standing on its own feet, you go straight to the free cash flow. Now, don't be fooled, as books like Creative Cash Flow Reporting have shown. Even cash flow can be subject to the creative hands of motivated accountants, but it remains the hardest metric to fake over the long term. It tells you if they are actually generating more real dollars than they spent. In SpaceX case, the answer right now is no. And understanding why this is the key to everything, you have to decide if that negative cash flow is one-time bridge to future dominance, like Amazon in its early years, or if it's just a pit. That distinction really matters. Once you understand how the money flows, you have to look at who it flows to. Every S-1 filing has a section on related party transactions, detailing the deals between the company and its own executives or affiliated entities. The question isn't whether these deals exist, it's whether they are being conducted at fair market rates. And finally, you have to look at the governance structure to understand what you are actually buying. Things like dual class shares, controlled company status, and voting power concentration are not just obscure legal details. They are the mechanisms that determine who actually holds the steering wheel once your money is in the bank. Let's tie this narrative back to SpaceX. The cash flow story reveals a massive growth investment phase funded partially by Starlink's genuine profitability. The related party story exposes a complex web of transactions across multiple Musk-affiliated entities. And the governance story confirms that while you might own the equity, the strategic control sits firmly with one person. These three threads, cash flow, insider deals, and corporate governance, wave together to give you a complete picture that no financial headline ever will. So let's bring it all together. SpaceX is simultaneously one of the most impressive companies to go public in a generation and one of the most structurally complex offerings in the market history. Both of those things are true at the same time. The bull case, Starlink's profitability, launch cost dominance, massive AI optionality, is genuine and substantial. The bear case, cash burn, governance concentration, speculative valuation built on AI multiples rather than aerospace fundamentals, is also real and documented in the company's own filing. And here is one more thing to consider, and this is purely my analysis, not just a prediction. So if you understand how large companies work over time, it wouldn't surprise me at all to see a spin-off in the coming years. SpaceX could separate Starlink, its profitable recurring revenue connectivity business, into its own publicly traded entity, or it could spin off XAI and the X platform once the AI division reaches scale. Why? Because that's exactly what happened with eBay and PayPal. They were bundled together for years and the market applied a blended valuation that undervalued the faster growing payments business. Activist investors Carl Icahn among them pushed for the split, and in 2015 PayPal spun off and immediately surged to 50 billion market capital. The sum of the parts is worth more than the whole. So the pattern repeats. Companies bundle to IPO at the highest possible multiple, then once the individual businesses mature, they unbundle to unlock shareholder value. You bundle in the AI narrative today to capture the premium, you separate tomorrow when each piece can stand on its own. This is not a flaw in the system, that is the system. So next time any company files an S-1, look past the glossy photos, read the cash flow statement, find the related party transactions, check the governance structure and ask yourself, is this company being valued for what it is today or for a narrative that may or may not materialize. The prospectus tells you everything, you just have to read it. See you in the next one.